Thanks for coming. My name is Soudien. I'm from a company called Geo Investing. I co-founded the company in 2007. Geo Investing was basically launched to help bring visibility to the MicroCap space, to investors actually, to help them understand the opportunities that I saw as a full-time investor for many years, since 1994. And I thought what a great thing to do to help enlighten this and other investors on what I'm seeing, and maybe actually meet other investors in the space and collaborate with ideas and find good ideas. So we basically have a subscriber network for the retail investor. We have an institutional research service offering to our hedge funds and institutional investors, and we're also currently launching a new product we call Executive Cast to help what we call the top 50 companies that we see out there to tell their story to the public, kind of from like the management's point of view. I really relate with managers, and because we think that's a missing piece in the MicroCap space right now. I think that a lot of investors need to connect with management and understand that there are good management teams out there. They're not all the typical pump and dump managers, teams that are related with the MicroCap space. So, and something we've been really trying to do, of late, is really trying to help bring exposure now to the outside, the retail investor space to, major media, Barrons, the Journal, Bloomberg, and we're developing relationships, and hopefully that'll help broaden the awareness of the space and bring more investors to it. We just recently got into Barrons for one of the pieces we did, which was a pretty tough thing, tough hill to climb, but we got there, and hopefully that'll open the door for more opportunities as more investors get involved in the space and more activists actually get involved in the space, which is a trend we keep seeing. We have 7 analysts, 2 traders, 3 marketing guys, and 5 on-the-ground researchers in China. We do a lot of work in China, trying to help find opportunities and protect investors from fraud in China. So what I wanted to basically talk about today, and then leading up into the main topic, I'm going to talk about long-term versus short-term investing. But before I do that, it's interesting maybe to kind of see where the MicroCap space is these days and how it's evolved somewhat. And I think you all know that the space has changed somewhat in terms of who's involved in it, participation rate. We have less institutions, less brokers. The retail investor kind of left the building for the most part. And the holding period of individual investors has significantly changed or been reduced. At one point it was 6, 7, 8 years. Now it's, according to a Credit Suisse report, about 4 months. And I've read some things where it was like days. So you have a very challenging, more volatile space you're playing in general. And I think that kind of affects the way you can evolve, maybe way you can travel through the MicroCap space and develop your strategies. So here's an interesting stat here. So it tells you that you can see the downtrend, the amount of individuals holding individual stocks. They're kind of going towards more kind of pooled investments. So that's one trend that's hurting stocks in general, I think, but mainly the MicroCap space is really being affected by it. Pre-2008, 2/3 of the trading volume came from the retail investor. Now it's flipped to more of your pooled investors like ETFs and such like that. So all that's basically kind of, I think, affected not only the amount of money coming into individual stocks in general, but now when you have less MicroCap investors, that makes the space a little more volatile at times and sporadic in terms of their rallies and move forward. So, so that leads me up to what I want to kind of talk about more here today, is the long-term versus short-term kind of debate that people talk about all the time. And a lot of times I'm asked if I'm a long-term investor or short-term investor, and my answer is always the same. I like to say I'm opportunistic, and I think a lot of MicroCap investors are opportunistic, and that's why we're in this market. But so at times though, I'm looking for what opportunities can be the most money right now. Not all the time, but I think it makes sense to be able to kind of combine a long-term investment strategy where you're going to sit through a stock, through the good and bad times, with other opportunities that are more opportunistic, and where you can find inflection points that are going to basically catalyze a stock. You're looking for example, if you can find inflection points that are going to temporarily lead to a new phase in a growth cycle, or you're looking for inflection points, for example, that are going to improve the risk profile of a company. And what you can have there is what I call, reversion to the mean, where you have companies that are undervalued, that their valuation multiples expand to the mean. And then you also have situations where you have, diversion from the mean, where you have companies that sometimes will expand the multiples beyond, their mean. So, and this is, these are, if you can define these inflection points, they might last. You define the inflection point, and so I define I'd like to define my investment time horizon, not necessarily by time, but how long I think the inflection point may or may last, and that could be, it could be weeks, it could be months, it could be years. So that's an interesting way I like to look at things. Now, this is to kind of portray the example of the pain of just looking to be a long-term investor and not looking at inflection points, like investing in management teams. Sometimes we invest in management teams, sometimes we invest in the brand, and we have confidence that we want to be with this company for maybe the next 5, next 10 years. But that's easier said than done. And I came across an article on Motley Fool by Morgan Housel. He writes for Motley Fool, and some of you may have read this article. And he talks about some of the pain that you have to go through for being a long-term investor. And he talks about Monster Beverage, MNST, which was the best performing stock from 1995 to 2015. Increased 105,000% during that time frame, turned $10,000 into $10 million. So I want to read some quotes here from what he wrote here. I think it's pretty interesting, and bear with me here. So he said, "The truth is that Monster has been a gut-wrenching nightmare to own over the last 20 years. It traded below its previous all-time high on 94% of days during that period. On average, its stock was 26% below its high of the previous 2 years. It suffered 4 separate drops of 50% or more. It lost more than 2/3 of its value twice and more than 3/4 once. That's how the stock market works. It's hard to grasp how the best performing stock in the last 20 years could spend the majority of that time with returns that would make you want to vomit." And he goes on, talking about the more. Now, that's one way of looking at it. He's a little dramatic potentially, but you have to be able to, it's easier said than done by looking at these multi-baggers. We all talk about multi-baggers. Your MicroCap investors, multi-baggers. I had this multi-bagger, I missed this one. But when you look at it in arrears, right, or after the events happen, it's easy. But to be able to go through volatility, and emotional volatility, is a skill. And that's why I'm really a fan of having those multi-baggers you're going to be betting on. But in the meantime, especially if you're a full-time investor, you need income, you need to make money, so you need to have these opportunistic type of investments, I think, to help you along the way to round out your portfolio. Now, when I was first came out of college, and it was 92, and I became a full-time investor. Theoretically, I was always investing, but I quit my job in 94 and decided to go full-time doing this. And I didn't really know what I was getting into yet necessarily. I didn't know. I really didn't go in there thinking, well, do I want to be a short-term investor, mid-term investor, long-term investor? I didn't know. I just jumped into it, and I found this microcaps was great. I was finding doubles and triples, and all these multi-baggers, and I was buying a lot of companies actually. I was buying a lot of stocks, so there was a lot of opportunity out there to do this. I had to actually diversify my portfolio, and as a microcap investor, I thought that was pretty interesting, that I could find these small companies that no one even heard about and that were doing this, and that was the good news. The bad news was after I made a lot of money. But then I learned how quickly multi-baggers can turn into what I call, mega busts. They just reverse the whole course. And so I did a little more analysis of my portfolio at the time, and I looked at some of my best performing stocks, where some of the best bagger returns I was getting we're about a year and a half into my holding period. And so I got into it more, and I figured, oh, look, well, I didn't know it yet, but I was finding these inflection points, not just earnings, there were just a lot of different ways of looking at these things. Through management interviews, you find things. So okay, it's interesting. And so I basically, as I've evolved into an investor, and I really put a lot more emphasis on trying to find these inflection points, and and finding these opportunistic points to blow my capital. So if I'm going to show you some things here now, some charts here, for example, some examples of some stocks that I early in my career, and I should say that look, we know that the short-term investing, or I hate to say use the word short-term, but the shorter-term investment type of mentality when you're looking at these inflection points, especially right now when the market's so volatile and there's a lot of unforeseen type of business risk out there. If you're careful, you can kind of try and reduce your exposure to the market volatility. You can reduce your exposure to unforeseen business risk. As you get better at doing it. So this is back in the 90s here when I was first really getting into it, and my first multi-bagger was wireless telecom. The stock was WTT. And the inflection point at that time was I noticed that the stock might have been in the midpoint of a margin cycle on the upswing, and I luckily got out because I thought eventually it peaked, and the stock today is trading. It's down 87% since then. TAC, Tandy Craft, real company, was a spin-off of Tandy Brands. They were a Western apparel retailer. They were expanding. I basically sold after seeing some of the same-store sales growth, statistics not looking as good anymore, and they based a lot of business. And then ALGI, American Locker Group, was a legitimate company, a tiny company, on the NASDAQ, and the stock increased from $13 to $100 in a matter of a few months, and they were making the post office, for the post office, they had a contract, and they were making the mailboxes for them. And I was interviewing the company, and I found out that the founder was not the greatest of health, and they had a contract coming up with the post office soon, and the son was going to take over. I interviewed the son, didn't have much faith in the son, and at that time, and I sold the stock, luckily, and they lost the contract, and the stock, got pummeled. So, then there's those examples, right? But there's examples that over here where I sold way too early. And, but they kind of like Monster used to be Hans, H-A-N-S. I owned that for a few minutes before it ran, and so I kicked myself in the back looking at that return, right? CHTR was a company that came out of bankruptcy. That was the inflection point, and Chapter 11 companies are great to buy sometimes out of bankruptcy. And PATK was one of the best multi-baggers, I think, here of the last several years, and I got a very small piece of it. But when you combine the two together, though, when you look at those opportunities, with these opportunities, with you start saying, okay, well, these are extreme. What if I can just better define my inflection points, not always looking for the mega bagger, because I want to avoid the round trip busts, I call them, and so I think that that it makes sense to at least consider this type of investment strategy especially for newer investors who are trying to get into this volatile market right now, and to learn how to really play the market. And the good thing about inflection point investing is it actually makes you really look for things. You look for things, and you're looking for change constantly, and it makes you a better long-term investor, and it actually makes you, in my opinion, connect with management teams a little more, because you're really asking really important questions. You don't have this like, all right, 10 years, we'll see what happens. You need to know, like right now, do you have a management team that, if you are wrong with your thesis, if you are wrong with your inflection points, if the market goes against you, you're willing to stick with the company. And because you have this mentality looking for inflection points and shorter term type of horizons, you need to be right. Because you want to keep doing this, it's recycling your investment. So the next question really is then, okay, well, are there, I've heard the argument, well, it's better to invest in one or two or three stocks long term because you get to know management teams better, you get intimate with them, which is always a good thing, by the way. And that there's not enough opportunity to find these 50 percenters, 100 percenters, 200 percenters, 300 percenters in the short term. And I beg to differ. That's Ziggy here is going to show you some statistics that we ran to show that the opportunity is there. And actually, the opportunity doesn't get better as you increase your investment horizon. So, flip to Ziggy over here.
Thank you very much, Marsh. He talked a little bit about our short-term versus long-term concept, and we ran some statistics trying to figure out do we actually see proof of the idea that there are more high return opportunities in the short run than the long run. And we did a study for the New York Stock Exchange. There are in our screen we had 4,229 companies in total. 31 companies at least doubled in the last 6 months, up to this day, to today. And about 82 companies, which is roughly 2%, at least doubled during the last year, which is a pretty random period. It's not as if we picked a low point or a high point. It's up to today for a 1 year period. You see 59 doubles, one 10-bagger actually, 15 triples. We thought that was very interesting, and we ran the same study for the NASDAQ, and then found again that about 2% of the companies doubled within the last 12 months. We have at least doubled or more. We had 43 doubles. We had actually 2 9-bagger in the NASDAQ study. And we looked at this data and we thought, well, it would be interesting to look at the over-the-counter market and kind of run a similar study for that in these microcaps and see what we find there. And surprisingly, and we excluded all the companies with market cap below $2 million because, and I'll talk about that in a minute, but a lot of these opportunities you couldn't take advantage of even though you would have seen them in advance. But here again, we found that about 2% of the companies doubled over the last year. At least doubled over the last year. The difference here is, as you can see, we had a lot more 10-baggers, more outsized returns compared to the other exchanges, to the NASDAQ or to the New York Stock Exchange. So this is an interesting insight. And then we said, well, these studies are interesting. Let's take that whole thing on to a long-term versus short-term study. And we ran a study, that and looked at companies that 5-folded in the last 3 years. If you have picked a low, the 3 years ago, and you had about a 1 year period, and you would have picked a relative low point, and we didn't go with the absolute low point, but a point where you could actually make a transaction, you would have found quite a lot of companies that 5-folded in the last 5 years, and that would work out to about a return of about 70% per annum. And we moved up the time horizon and said, now how many companies 11-folded in 5 years, which is about, again, between 60 and 70% annualized return. And we found that, roughly there's only half as many companies out there that provided the excessive return over an extended period of time. And then when we took it to a 10-year period and looked at the 100 baggers or 101 baggers, which is just below 60% per annum return, the number, again, became a lot smaller. So we figured out from this study, the intuition is kind of confirmed that there are more opportunities to get outsized return over a short run than, it's hard for companies to sustain these outsized returns over long periods of time. Well, this is all good and nice, but we want to talk a little bit about the challenges of inflection point investing and weaknesses in our study as well. Because, let's be real about it, a lot of these companies you couldn't have, some of these companies, a great percentage, especially in the over-the-counter market, you couldn't have bought at the price, the implementation cost would have been significant. You couldn't have picked the low point either. However, we don't want to prove with the study that there is a certain amount of stocks that you're looking for, but we want to confirm the intuition that the outsized returns are probably easier to find in investments that are shorter term, 3 years, 1 year, 5 years. Of course, there are a lot of challenges involved in inflection point investing. First one being is that the time and workload is intense. You have to go and read all the filings. You have to do the on-the-ground due diligence. You want to talk with management, suppliers, former employees, current employees, customers, competitors. So you either want to be a full-time professional or want to engage a team of full-time professionals. You need to have a good understanding of the business in general in order to understand the impacts. In order to understand an inflection point properly, you want to have a basic understanding of the business, and this is why we try to follow a lot of businesses over an extended period of times. When we look at a business, we don't lay it aside as soon as we decide not to make an investment, but we'll keep tracking it. And This way, we'll actually find our, multi-bagger that we are willing to extend for, that we're willing to hold for an extended period of time. But I'll talk about that on the next slide. You want to have a strong selling discipline and a strong understanding of intrinsic value. If you're operating with a time horizon, and Marsh said, you want to have a time horizon attached to your investment theory. You have an inflection point, and you say, well, this should play out over, say, the next half year, maybe the next year, maybe even just the next month. Well, you want to adjust your selling strategy accordingly, set a price target, and then be disciplined in implementing it. Pre-commitment is a very important part for investors to stay disciplined. And the last point is something that we've all seen. We found a great investment and thought, this is, as soon as everybody else knows it, the stock is going to go up, but maybe the inflection point might not be recognized by the market for an extended period of time, even though on the business level you see the things happening that you hope for, but the stock doesn't move. Well, this might be a problem too, and it's a problem that you often encounter in inflection point investing. So let's go about how we try to implement it, to counter all these challenges. Well, we try to get not obsessed about one company. We try to not be married to one company, and we never say this is a company we're going to hold forever at whatever price. We never go this way. We try to turn many rocks and follow many companies. It's actually a Peter Lynch quote. One of his students who actually runs a contraband fund, it's a $204 billion fund, said about Peter. Peter liked to turn more rocks than anybody else. He liked to see more companies than anybody else because he believed by seeing more companies he would come across more good investment opportunities. Of course, there's a balance to be held between the degree of understanding and the amount of companies that you cover. But we try to cover as many companies as we can to anticipate inflection points and have an understanding of where the company is going. We average up as conviction grows. As Marsh said, it's not all about inflection point investing. We use that basically as a tool to find our multi-baggers, our 100 baggers of the companies that we are really like, and we're willing to go through a lot of volatility with them. And as you see management teams continuously executing, hitting these inflection points and making it work, that makes our conviction in the company grow and that enables us to comfortably invest in a lot of volatility over long periods of time, and we're prepared for the roller coaster ride. If you have a great company, and Marsh talked about that with Monster Beverage, if you have a great company and you want to hold it for an extended period of time, be prepared for extreme volatility. I already talked about that briefly. We have a strong sell discipline and definition of intrinsic value. When we pre-commit to something and the fundamentals don't change drastically, we don't go back and reevaluate our selling plan or our estimate of intrinsic value. It's too easy to trick yourself, in the heat of the situation, to believing, well, maybe it has another $2-3 in it. But I think you want to pre-commit as an investor and define the rules before you go into battle, so you don't have to withstand the emotions at this point in time. We define a time horizon for every investment thesis. As Marsh said, our inflection points, we have a very firm understanding, and that isn't down to the day, but we have a firm understanding of time horizon. We expect this to play out within the next half year, 2 years, 3 years, but we have an idea. We don't go into situations blindly without having thought about these things beforehand. And the last tip, which is not on the slide, but I think it's been a quite useful mental exercise to us. We do the postmortem of an investment before we enter into investment. So once we have the investment thesis set up, time horizon defined, and we set all our expectations, and we wrote them down on paper so we can go back and not trick ourselves afterwards into, we knew it all along. We take a step back when we reach that point and say, well, it's half a year from now. Imagine it was half a year from now or a year from now, and the stock did horribly. Everything went wrong. What could have gone wrong? What will we think a year from now? Will we buy more? Will we sell out of our position? By going through this mental exercise, I feel at least that our investment decisions have been better, by and large. We do more due diligence, and we're a little more cautious about taking big positions and committing to companies for longer periods of time overall. That was our presentation. Thank you. That's the last slide, I'm sorry. That's the last slide about how we implemented. Marsh talked about our research network. We reinforce our research and ideas through publications. our network of investors, retail investors, institutional investors, spans across approximately 300,000 people that read our reports. I talked a little bit about the Postmortem before initiating an investment. And this is actually really the last point. Be patient and be prepared for opportunities. We feel that sometimes people feel forced into a strategy. They feel forced into doing something. We think you should always adjust your behavior so it makes sense given the circumstances. And as Marsh talked about it, circumstances, especially in the microcap space, have changed, and we try to adjust our behavior accordingly. Well, that is it. Thank you very much for your time. If you have any questions, or if you want to know more about the studies and how they were conducted, please get back to us. If you have any questions now, please feel free to ask.
Yeah, a lot of these microstock and cap companies usually do a reverse split.
Of course, we adjusted for these. No. We went through the list of stocks in our output one by one. So we adjusted for splits and corporate transactions that might look the data, or might let the data appear differently than it really is. Yes, please.
What are some examples of business models that you would categorize as more on the short-term horizon, where you buy and then maybe wait for, I don't know, I'm thinking like single product tech companies where they Christmas, get it out.
Yeah.
That kind of stuff.
I think Marsh, you want to comment on this?
So, we're looking, we're looking for not just you're talking like a fad situation. We're looking for actual, very tangible kind of events or a very meaningful trend that's going to affect maybe more than one company. So, for example, in 2013, 14, there was a trend for SaaS companies. There was a big acquisition spree. So we were looking at, which inflection points some of these companies might be entering to qualify them for being an acquisition target, and we wrote about actually 3 of them, and they were acquired. So things like that, we're still, you can have that short-term type of thing, right? But the market's getting smarter. Christmas is coming. That those shares might already be expensive, and that kind of thing. We're looking for more of a hidden opportunity that kind of people haven't really found and really put the pulse on yet, that's going to rear itself. That's one example, I guess I could. There's so many.
A good presentation, I enjoyed it. How often, when you look at you define your time horizon up front, have you gone back and looked how often the actual time horizon compares to the forecasted time horizon? Have you guys been pretty accurate at being able to predict this will play out over 18 months, for 6 months, for 3 years?
We don't collect extensive data on that yet, so we don't have like a long-term 10-year back study that we could really say, okay, we're that accurate. We tend to be fairly accurate in the sense that we have defined a time horizon, and then we're fairly disciplined in selling it afterwards. So, for example, a company, NTP, a company announced a major buyback for over a 1-month period, for example, and you're pretty certain, that you want to see the stock, or want to see something happen within the next month. And then as this ends, you want to exit your position. So by and large, it depends as well on the overall time horizon. If you have, for example, a 1-2 year time horizon, we're willing to, be off by a couple of months, But in the shorter term our investment horizon on ideas gets, the more, precise we tend to be, and good, on point, when it played out or it didn't play out.
But the toughest part about it is actually executing on your inflection point selling. Because, for me, I think all of us find opportunities. We find them, and we all have our different skills in how we find them. But it all comes with self-discipline, because, you might, if you've called your inflection point right, you see it rising, you get emotional, maybe it's got a little more in it, right? And that's some of the things we struggle with all the time, is because, you don't necessarily know when the inflection point is going to end, and you might think you do, and you're either going to sell too early or you're going to sell too late. That's what's going to happen, and and it's very mentally tough. So I am a better investor when I stick with my plan. I define my inflection point, target, if the target doesn't get there within a certain time, I go back, what's wrong, what's going on? Because if I define an inflection point, I think it's going to last 6 months. And the things have happened to move it. I mean, to theoretically move this, and it hasn't moved. Now it's 8 months into it. I'm getting a little scared because it didn't work out. And now you get in this emotional conundrum, like, what do I do now? It's still a good company, but it didn't work. And that happens more now in this space than ever because of the lack of participation in investors, the volatility, the short-term mindset of traders. These microcap companies have incredible swings. I mean, they'll move, you know, they'll take maybe 3 months to double, and then 2 days to lose 50% of that value. And it becomes very frustrating, and it makes it all the more important to really try and find these inflection points and be able to say, oh yeah, maybe our investment in this company is going to work out, but it didn't work out during the time frame we specified, so we got to get out. And I struggled with this on a recent stock I just bought. It was called a BGSF, a big staffing. And the stock was, we had bought the stock originally. I think it was around $12. It was a staffing company paying like a 9% dividend. Low PE, being valued as a value company, but I knew they were going to go through some acquisitions. They made some acquisitions. There was some dirt in the numbers, so the growth wasn't really looking that great. We stripped out all the GAAP the non-GAAP information. So hey, this is really looking pretty good on an EPS basis and EBITDA basis if you take all the adjustments. So we held it, and and the stock went to got as high as I think it was 16 in a short order, and then the the company announced a secondary offering after market close one day. Stock plummeted, $14. Like, are you kidding me? And so everything basically gone, so I read the press release, and the press release didn't really say much about what they were going to use the money for. But we need to go read the use of proceeds in the prospectus. And this company, lo and behold, was very specific in the use of proceeds, saying we're going to use this to pay down all of our debt. So now it's a 9% dividend yield. It's being priced that way because there's some risk in the balance sheet part of it. So now you have a better balance sheet, and it was going to be slightly accretive to earnings, not dilutive. So I called the broker up saying I want some of this secondary. So we bought a bunch of it, at $14, and the stock. This is where it gets interesting. So our inflection point target was, all right, it's going to get back to $16, $17, and that's where we go. So we said, we got there. I'm like, damn, pretty quickly. So we said, we'll sell some here, but we're going to keep some for the ride, and we did. And it got, because we thought there was going to be accretion in these numbers, significant accretion. So the stock got to $22. This is all within, I think, 6 weeks maybe, right? And their earnings weren't that, they missed analyst estimates. Because the analysts did not know how to calculate non-GAAP numbers. The way the analysts calculated the number was Roth Capital, by the way. Calculated different than the company did. It just caused a mess. And then the company had a wrong non-GAAP number. So it was just a mess. And I sat there looking at it. All right, well, I know it's worth more. The investors are going to figure it out. And it was stupid. And the stock came down. I ended up selling the rest of my position as it was coming down. Now it's sitting at $13. Still made money in it, but I talked myself into thinking the market was going to figure this out. When I knew what the original inflection point was, I know they're going to figure this out. And then I said, now is a different situation where maybe they'll figure it out. And I thought maybe because that Roth had their number, the company had their number, they're just going to figure this out, and they're going to, they really didn't miss the estimate that much, they're going to take it back up. Well, no. And what I think might be happening is it's potentially, I don't know, if maybe there's something else going on with the industry too. Things are changing so quickly. So, and I know in the conference call they talked about some problems they were having in the short run with one of their customers. So all this thing, and I missed the conference call. So all these small little details, hurt me a little bit. And I got a little greedy. So that's an example of, not sticking with the inflection point theory necessarily. Maybe I would have sold it all at $16, $17 if I would have stuck to my theory, and I would have missed, I would have saved myself, and on average, I would have saved myself. So that's an example of another one like that. Yeah. So that's hope I answered that question a little bit, but I think that it's what we're wrong on sometimes is when to sell it. We're human. And that's to me was one of the hardest things I had to adjust to post 2008. Being an investor in the 90s, and through 2000, before 2008, there was a formula I used to follow, and you could depend on a company reporting earnings, reporting good news, the stock reacting within one or two reporting periods, getting your PE, targets, it's a longer trek now. It's a more volatile trek to your price targets these days. So that's the challenge I deal with all the time, and it's because we're human, and especially being a full-time investor, you need to make income. So there's all this pressure all the time, and you see how volatile the market is. It just definitely is a new. But that's why I think inflection point investing, if you can do it and stick to it, it will definitely improves, your returns. So hope that answers the question. Yeah, that's it. Thank you.